Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and typically would be the mayor, the smartest guy in the room, Mr. Michael Becker, but he is on another due diligence assignment. That guy is a busy guy. So in the podcast today, we have the professor, the man himself, James Eng. James, how are you?
Great. Thanks for having me, Paul.
What's going on in the Old Capital world these days, James?
I think first off, our speaker series coming up on Wednesday, February 6th.
Yep.
Is with Freddie Mac, and we are bringing in one of their economists who is going to shed a little light on how Freddie's looking at not only the Texas markets, but then also their debt and how it's performing. So that will be a great event for you to come out and meet them and also 200 or 300 of our friends.
200 or 300 opportunities to network with people that are in the multifamily business. You know, you may have opportunities, but this is at one place that you'll meet a lot of investors, a lot of people that have invested in multifamily. I want you to come out and pick their brain, have them explain to you what they do, kind of see if that's something that you want to do in the future. So this is a great event. And again, what day is this? That's
Wednesday, February 6th. So that one will be a nighttime event. And then I think the next big event after that will be our basketball tournament. So
I can't wait for this one. If you have heard the podcast that we had with Karen Volker with City House, I mean, she really tugged at my heartstrings about why we're doing this, to try to get money into what they do. James, tell us a little bit about where this money is going to go for.
Sure. So we're putting on a 3-on-3 basketball tournament Saturday, March 30th here in Dallas. And all of the proceeds from the registrations and the sponsors are going to City House. So City House really helps kids anywhere from 5 days old all the way up until age 18. And then even once they're past 18, really transition into the workforce. And they are doing a phenomenal job. And we are raising money for one of their facilities here in Dallas. So
the 3-on-3 is a basketball tournament. So if you're a boy, if you're a girl and you want to play, and now we're not going to have the ringers play. It's going to be all folks from multifamily, whether they're brokers or investors or self-directed IRA folks or appraisers. These are all the people from the industry. These are the people that you want to know to try to develop a relationship with. They're going to be playing basketball. They're going to be hooping and hollering for you to do well. And we're going to have 30 teams out there.
Yeah, we're going to try to have a little mini NCAA tournament. So we're going to shoot for 32 teams.
It's going to be at Southern Methodist University in their gym house. And so we're going to have a lot of people that are going to be playing some basketball. We want you to come out. We want you to play. We want you to put together a team. If you want to volunteer, we'd love to have you out there too. But again, at SMU on March the what?
March 30th. So it's Saturday morning.
Yeah, go to the Old Capital Podcast website, oldcapitalpodcast.com, and register to be part of that fantastic and worthwhile event as we raise money for Hoops for Homelessness. So anything else, James?
No, that's perfect.
In the podcast, again, we have the professor, James Eng. He's going to talk a little bit about what's going on in the industry itself. I mean, you know, we talk to appraisers, we talk to underwriters, we talk with investors, and you know, we kind of have our ear to the ground. You may listen to an investor who's hyping you up, trying to get you excited about what's going on, why you want to get in the industry. We're making these huge rates of return. You know, these are individuals that may be engineers, but they're trying to transition into multifamily. So James in the podcast today, this is a very unique piece because James is going to talk a little bit about where the REITs, where the people who are actually buying some of on the institutional side, where they see the market at. So these are the people that are the smartest guys in the room, so to speak. We wanted to kind of pick their brain and kind of find out where they're putting money, where they're investing in. We want to tell you a little bit more than what you're typically going to get from anybody else. So James, again, lay out what we're going to talk about today.
So at the end of 2018, there is a gathering of REITs, and REITs are real estate investment trusts. And so these are people who are publicly traded companies, and their sole goal is to invest in real estate and distribute the income to you, the investors. And, there's over 100 different types of REITs. And really, there's about 20 multifamily REITs. So these guys own anywhere from 10,000 units all the way up to over 100,000 units. And so they have the pulse on not only their portfolio, but they're looking around, seeing what other people are doing as well. And so I went through the top 10 multifamily owners and operators and really sort of pulled out the nuggets here for you guys. And so I'm going to cover 6 things. Number 1, how they choose markets. Number 2, how they choose properties. Number 3, what value add improvements they are making to drive rent growth and how much rent growth they're seeing. Number 4, why they are still building Class A developments. Number 5, risk in the forecast for 2019 and how to mitigate possibly some of those risks. And then number 6, the fundamentals in multifamily in terms of long-term demand. And so those are the 6 things that we're going to be covering today.
Very excited. So let's go to number 1. So how do they choose markets?
So when you look across the U.S., these guys can invest anywhere. And the first way that I want to highlight 2 REITs, the number 1 thing they look at is household income to the price of a median home. So median home price to median household income.
Okay.
So the national average is about 4x. So the home price, let's say on average is about $250,000 in the US, and then the median household income is about $58,000. So the markets that you typically think about, Phoenix, Houston, Atlanta, Dallas, Orlando, all of those are about 4x. The 2 REITs, one Equity Residential, who has about 80,000 units, and then Essex Property Trust has about 30,000 units. They look at markets such as Manhattan, which is a 14x, San Francisco 9x, LA is 9x, Seattle 6x, Boston 5.5x. So those are the markets that they're focused on. And we've seen all these reports that home ownership is so low. Home ownership is only 64% across the nation. In these markets, it's typically 50 to 55%. And so in these markets, these guys are just perpetual renters. They might not ever buy a house in Manhattan or San Francisco. And so one interesting thing on Equity Residential's pitch, they said that only 6% of their residents move out to buy a house. Only 6%. And so their focus on these sort of West Coast and East Coast markets is how they decide where to invest. And what was interesting is Equity Residential actually started looking at Denver a lot more this year because of the high cost of single family ownership. But then the wage growth was there, and also millennials, they just want to be sort of near highly walkable public transit. And so they're actually moving into Denver. And Essex, one of the unique things that they, not only the high cost of ownership when they look at markets, but in terms of a housing shortage, I guess, I don't know if it was HUD, did a housing shortage study, and 50% of the shortage for housing was in California. And so they are heavily invested in California. So they are in northern, southern, and in Seattle, Essex. And so that's one metric on how they choose markets, household income to median home price. And then the other 2 that I want to highlight, they look at what we typically look at. So high employment, which is leading to increased population in the B and C space. And the first REIT was a Canadian REIT called Pure Multifamily. So they own about 7,000 units. And they are in Canada, are based in Canada.
Yeah, very familiar
and
with them.
What was funny was they had a slide. So in Canada, all of the apartment transaction volume totaled about $4 billion. Okay. In Texas, in 1 year, the total apartment volume was about 20 billion. So 5 times the amount. And then the GDP of just Texas, the GDP of Texas is about 1.7 trillion, and that exceeds all of Canada. So all of those Canadians out there, we love you, but Texas is definitely growing and is about 50% of the population compared to Canada. I think there's about 18 million that just live between the four major cities, sort of the Texas Triangle here in, Dallas down to Houston, over to San Antonio and back up. 18 million people live in that triangle, and that's about half the population of Canada. So they are focused on Texas, even though they're in Canada, which I thought was unique. And then the largest apartment owner is a group called MAA, and they are focused on employment and population. And they had a slide which was pretty unique, and it said 24% of the apartment market has a rent between $1,000 and $1,300. Okay, $1,000 to $1,300, 24% of the market. So about 25% of the market, quarter of the market. But MAA has 44% of its portfolio in that rent range. So they are and they have only 4% in the top 10 markets, the gateway markets, so the coastal markets, and they are 0% in California. That's the largest apartment owner in all of the U.S. in terms of REITs. So I thought that was pretty unique. So they are focused on Atlanta, Dallas, Charlotte, Washington, D.C., Tampa, Austin, Orlando, Nashville, Houston, and Fort Worth. So those are the markets.
Yeah, so that's what you should be focused on, the top markets: Atlanta, Dallas, Charlotte, Washington, D.C., Tampa, Austin, Orlando, Raleigh, Nashville, Houston, and good old Fort Worth.
So I always like to start sort of high level, and first you got to find what market I want to invest in. So those, I think, are two great metrics to take a look at when you're looking at in picking a market. And then the second thing is, once you find a market, you got to find a property.
Yep.
And so
number two is, how do they choose the property to invest in?
How do you choose your property? So one of the ways, equity residential, which they are in sort of those top home price to medium household income. First off, they look at walk score, which shows sort of how close retail is to you. So high density, and they're also looking near public transportation. And then a couple of the other REITs I thought was interesting. Almost all of these guys are looking over 200 units, the value add opportunity, and then they are looking for access to retail, school district, good school districts, and then also airport. So being close to an international airport with accessibility to a major highway. So I remember Chris Faulkner told me he wants to be within 5 minutes of the nearest highway when he's looking for a property. And so how far does it take from your property to the closest highway, whether going north, south, or east, west? Getting there within 5 minutes from the property in terms of ease of access to employment drivers is a key. So when they look at properties, they sort of want to try to check the box on as many of those things as possible.
So looking down, again, top markets, and then going into what properties in those markets, and the things that we want to take a look at where the property should be physically in what submarket. So number three is, how much are value-added upgrades costing and increasing rents?
Right. So on a lot of these projections, we typically on the front end see the pro formas. We see the rehab budgets. We see how much these rehabs are going to cost and what's the estimate. What's unique about these guys is they are doing so many rehabs and spending so much money on all these units. And I wanted to point out some examples of what these guys are doing. So Camden, which is a huge owner here based in Houston, and they have a large presence throughout the Southeast. They spent about $325 million last year on kitchen and bath areas, appliances, flooring, fixtures, and lighting. And it cost them about $12,000 a unit.
Wow. And
they raised the rent on average about $100 a month. And so that was Camden. And equity residential, $50 million. They also got about a 10% return on the rent, and they're buying newer stuff. And so they're actually focused on what are the sort of customer facing projects. So when somebody comes in the door, how does the lobby look? How do the amenities look? Because a lot of times once they get back to the unit, they're competing against new supply. And, once they get back to the unit, they look pretty similar, but what's all the stuff in between? So maybe if they buy something that was built in 2008, how do I compete versus something in 2018?
Yeah, that front lobby area is the hook.
Yeah, the hook into it. So another one, the larger I don't know if it was because MAA did so many units. They did about 20,000 units. So they did stainless steel appliances, countertops, cabinetry, plumbing, light fixtures, flooring. They spent about 5,000 to 6,000 a door, getting about a 10% rental increase. And so, just doing the math on MAAs, 5,000 a door, 20,000 units, they spent $100 million in capital. And that 10% increase on revenue at, let's call it a 5.5 cap rate, that created about $357 million in value. And so, net after the $100 million of capital, a $250 million increase to their valuation. And so these guys, a lot of times we're looking just specifically at a property. These guys are doing it across thousands of doors, and it is working. And this is a huge selling point to their investors, is when they're able to find these value add plays and really add a lot of value with these 5,000 to 10,000 a door. But it seemed on average, most were getting about 10 to 15% rental increase with these.
I want to talk about that IRET.
Yep.
Can you talk a little bit about that and some of the things that they're doing?
Yep. So
upgrade their properties?
iREIT is another. So these guys are a little bit more unique. They have about 13,000 units, and they actually own a ton in Minnesota.
Really?
So they're more of a Midwest REIT, and they spent about $15 million across 1,000 units last year. So they're doing your kitchen, your tile backsplash, but they're also doing the USB outlets, the package lockers, and the LED lighting. And then they're, one of the unique things, they did a case study. They spent a little bit more money and went a little bit more high end. You got to make sure that your market can support it, but they went 16,000 a door to get up to 230 a unit on the rental increase. And so just making sure you understand your market and whether or not it can support that level of increase.
So number 4, why are we still building new units? Stabilized yield versus yield on sale.
And so everyone, when you look at new supply, Dallas Fort Worth is the leader across the country by a long shot. And everyone keeps asking, why are they still building? And there is a property right across the street from us here in Frisco, and MAA owns it, and they are adding another 348 units. And people are like, why are we building more units? And if you actually look on their presentation, it cost them about $69 million to build, total cost into the deal, to build 348 units, which is about 200 a door. Okay. And they are expecting, based on that cost, to get to a stabilized NOI of about $4.5 million, which comes out to about a 6.5 cap. Okay. And in today's market, they're able to sell brand new product at probably closer to 4.5 to 5% cap. Mm-hmm. So that generates a value of about $97 million. So $97 million value, a cost of $70 million, that's a gain of $28 million. And so that difference between what they're able to build to versus the cap rate that they can sell at is creating that gain, where on some of these other value add plays, they are just not able to generate. And a lot of these REITs have a lot of money to invest, and so they got to put it to work. And so I saw this across. MAA is doing this, Avalon Bay, Camden, iREIT, all these guys are still developing in areas that, this is probably 1 minute away from the Dallas North Tollway and 2 minutes away from 121 that goes straight to the airport. And so they got the location piece right. And they're saying the demand is going to be there, and it's going to cost me $70 million to build it, and I can sell it for close to $100 million. And so they'll take that deal all day. So,
wow.
Yeah. So the number of units is going to keep increasing as long as that construction cost, all of a sudden, if that construction cost goes up to 75, 80, 85 million because of tariffs, because of labor costs, then that equation changes and the development slows down. And I think it has slowed down in some of the other markets, but Dallas has continued to grow. And the one unique thing is that as these guys are looking at developments, one REIT actually partnered with another developer, and financing for development has gotten somewhat harder. And so you might be at 60 to 65%. And so you might have to go out and raise 35% of equity. And iREIT actually came in and they started doing a second mortgage, a mezz piece, where they provided that mezz piece that maybe got them to 80% leverage. And then they actually are buying the right to buy that building already. And so they're providing capital, a little bit higher risk capital than your first mortgage, but then also getting paid income and then actually negotiating a cap rate at the very beginning. And so instead of maybe paying a 4.5 cap, if it was a listed deal, they might buy it at a 5 or 5.5 cap. And so some of these REITs are getting pretty sophisticated in how to win deals. Instead of waiting for it to be listed 2 years from now, let me put in a little money on the front end, get paid to wait, and then take it right from you once it's stabilized.
That makes sense.
And so I think is sort of one of the unique ways of, when you're looking across, different ways of adding value to whether it's general partners or limited partners, thinking of different ways to add value to them in the meantime before that next deal comes up is key.
So what are they seeing for the risks for 2019, James?
I think, number one, that new supply, that definitely was hit on across all the presentations. Some of the ones that are in the major markets on the coast, even though there is new supply, it typically is less than 1% of the total inventory. So they do not see that as a huge risk. So look at the total inventory in your market, and then if it's less than 1%, they don't see that as a huge risk. And then the other thing is the amount of construction costs and zoning costs and all the things that are necessary to get a property up and running is continually increasing. So they think that that's going to slow down. And then here in sort of your Dallas, Houston, Austin markets where there is a lot more supply, most of those REITs are buying in the B and C space. So like MAA, we mentioned they're staying in that $1,000 to $1,300 rent range.
Which is B and C product.
B and C product. And it's the A rents have a long way to fall before we start seeing that new supply impacting. So while the new supply is there, they are sort of mitigating it with those couple things.
What are they talking about for interest rates? Any concerns with that?
Yeah, so interest rates was number 2. And what was unique is where we see a lot of syndicators, they're trying to go high leverage, 75, 80% leverage. A lot of these REITs are very low leverage.
Yep.
So they are 50% levered on a majority of their deals. And a lot of them are fixed rate debt, long-term maturities. And as you start building a portfolio, on your first deal, it's not as important. They acquire these properties over time, but they also look at and make sure they look at the next 10 years and make sure that in 1 year, they don't have 50% of their maturities in 1 year. So if there is a market slowdown or if there is a market, so when your loan is maturing, making sure that it's sort of spread out. So they like to have, let's say, 10% of their maturities over the next 10 years. And then obviously the stuff in the next 1 to 3 years is either fixed rate or they have the liquidity to take those maturities out with cash.
I say, have a strong conversation today about lower yields back to investors. Everybody thinks 200, 300% is where if you put money into these deals, that's not the environment today. It is, single digits, double digit, small double digits in the IRRs. But a lot of folks want to get up to higher leverage. They want still 75, 80%, and they try to do it either through a mezz loan or for a bridge loan, trying to get the higher stuff. I would say you may have to have a lot tougher conversation down the road if there's a hiccup in the economy and you can't get taken out with that bridge loan, because a lot of these bridge lenders can be, they loan to own. So you could find yourself with a maturity coming at a bad time. So talk to your investors about keeping their rates of return lower or modest. So talking about that, why are apartments still good for the long term?
Right. So, there's going to be some risk, obviously, for 2019. But, the big thing that all these guys hit on was the long-term demand for apartments. And, really, they started with sort of the rent by choice. And so just the lifestyle choices of millennials, getting married later in life, having kids later in life, that propensity to rent is increasing. And then also the renting, not only because you want to, but because you have to. And so there is, even though if somebody did want to purchase a home, the need for strong credit score, significant down payment. A lot of these, millennials are carrying student loan debt and they don't have a down payment to put down. And so with single family house affordability being so much higher, a lot of these REITs just see the rental demand for millennials continuing. And then also on the other end of the spectrum, a lot of the baby boomers have said they're tired of owning their larger single family and they're okay renting in the future. And so that demand is there. And then also, in terms of supply from 2009 to 2015, they saw there was, Marcus and Millichap had this a couple of months ago, but they saw, just an underbuilding. If you combine the single family and multifamily housing stock compared to the demand, it just was not keeping up. And so they think we are still undersupplied in terms of housing. And those are they're the demand drivers that they see long term for multifamily.
You had mentioned that construction loans are much more difficult to attain, time to get the deal put together with the county, with the cities, and get it all done, and seeing materials price increases. I mean, it can be difficult on supply too, to get these buildings out of the ground. So if you were trying to summarize this whole thing on bullet points 1 through 6, what's kind of your summary?
All these REITs put together presentations to sit in front of investors. And you might not necessarily be investing in a REIT, but you are investing with a syndicator. And you have to understand how to choose markets, how to choose properties. You have to understand the business plan, and you have to agree sort of with the concept of the multifamily fundamentals going forward. But the last and most important thing is the operator. Mm-hmm. And so the things that these guys stressed and what we stress, especially as an LP or even as a general partner who is going out there raising money, it always starts with the operator, whether it's a REIT or a syndicator. And so I wanted to highlight sort of 5 things as an operator. Number 1, what is the track record of sort of the syndicator or senior management of a REIT? Have they done this before? What is the proof that they have done this? Number 2, an aligned interest. So how much is the operator investing in the deal? So it was actually pretty unique. Some of the REITs, they started and they owned more. It was really their own account. And they've gone out and created a REIT, but they still own, a lot of these founders own 20, 30% of the equity in these deals. And so that gives me a lot of comfort that, these guys aren't doing deals just to do deals. Their money is right next to mine, side by side. Number 3 is operations. So who's going to actually manage the asset? Is it this guy? Is it self-managed, or is it going to be a third party? Number 4 is the balance sheet and liquidity. So all these guys are anywhere from 50 to 60% levered on their portfolio, and they are holding a ton of liquidity in case there is a downturn or if they need it to support a deal in any way. And so the same way when you're investing with a general partner, if this deal goes sideways, is there enough money at the entity level, or can the general partner put in more money to support this deal? If occupancy drops, they're still going to have to pay that debt service payment. And if there's a large CapEx need for that property, are you guys properly capitalized? So looking at the balance sheet and liquidity of the general partner. And then the final thing is, this happens a little bit more informally, but referrals of previous investors. And so a lot of REITs talked about, look at my track record for the last 15, 20 years, go talk to these investors and talk about how I communicate with them, how we did this project, what was the return for that project. So I think that's a fair question to ask general partners is, can you give me a couple referrals of people, contacts that have invested with you previously? And the question I would go and ask these previous investors is, would you invest with this guy again or this gal again? Because that to me is the best question you could probably ask to an investor, because they've sort of been in a partnership with them for 2, 3, 4 years. And everybody looks great on the PowerPoint, on the webinar, the first 30 minutes. But, 2 years, 3 years into the deal, things can change.
Certainly can. Certainly can. Some great information, James. How are you so damn smart? Is it the University of Texas Business School? Is that who I need to send a check to? So if someone wanted to get your notes in writing to share with their limited partners or even their spouses to kind of get something in writing from you, what's the best way for them to do it?
I think the best way, you can definitely go to oldcapitalpodcast.com and reach out to us there. And, my contact information is on there as well. And you just reach out to me and we will be able to get you the sort of white paper and notes that we put together.
Yeah. As you know, Old Capital Lending did over $1 billion in apartment loans last year. I think we're one of the largest in the Southwest, and we do lending all throughout the United States. And you can hear the quality of folks on our podcast that are actually involved in lending and some of the value-added services that we do to make sure that you're smart in getting into these transactions. Anybody can do a loan, so to speak. Anybody can be a loan officer. There's not a lot of licensing to be that. But I think we have the best crew at Old Capital, the folks that are looking out for you and making sure that you're doing the right thing and standing over you and making sure that that you're going in the right direction. So, James, thanks for being part of the team. We appreciate some great information on this. Some of the smartest people in the real estate investment trust area have given us some great information. Hopefully, we were able to communicate clearly to everyone in the audience. So we appreciate that. So again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.